Welcome to the Leaders Insights podcast. Today's episode, Managing Activist Investors, a CFO's step-by-step playbook. An activist just took a stake and fired off a public letter demanding board seats. The CFO has, 72 hours before the story writes itself?
Less. By the time that letter lands, the activist has been building the narrative for months. They filed their position quietly, lined up their sell-side allies, and rehearsed their sound bites. You're the one caught flat-footed.
That sounds like an excuse. Aren't CFOs supposed to see this coming?
They should, and the good ones do. Look at what happened with Elliott Management and Southwest Airlines back in 2024. Elliott built roughly an 11% stake, and the board eventually reshuffled seats. That campaign didn't materialize overnight. The tells were there: stagnant margins, a share price that lagged peers for years. If your total shareholder return, the stock gain plus dividends, trails your competitors for 3 years running, you're already on somebody's target list.
So the campaign starts before the letter. What's the first thing a CFO actually does?
You run a self-audit, and you run it cold. Pretend you're the activist. Where's the fat? Where's the underperforming division you've been protecting for sentimental reasons? Every activist deck starts with a sum-of-the-parts analysis. They add up what each business would be worth if sold separately, and show it beats your current market value. If you haven't done that math on yourself, they've already outworked you.
That's uncomfortable. You're telling CFOs to write the attack memo against their own company.
Exactly. Because if you can't, someone at Starboard or Trian will do it for you, and they'll do it better. The playbook calls it a vulnerability assessment. I call it looking in the mirror before someone smashes it.
Fine. Say you've done the audit, the activist calls. Do you take the meeting or stonewall?
You take it. Stonewalling is how you turn a private conversation into a proxy fight, a public battle for shareholder votes to change the board. That's the expensive nightmare. When Nelson Peltz went after Disney, that contest reportedly cost both sides north of $70 million combined in advisor fees. You don't want that. You want to engage early, listen, and figure out which demands are reasonable.
But isn't engage constructively just corporate code for caving?
No. Engaging means you separate the good ideas from the ego. Sometimes the activist is right. The segment is dragging. The buyback is overdue. Give ground on the defensible stuff. Then you have credibility when you draw a hard line on the demands that would gut long-term value, like slashing R&D to juice next quarter's earnings.
How do you keep the board from panicking and throwing you under the bus?
You brief them before the crisis, not during it. The CFO who walks into a board meeting the day the letter drops with no plan is the CFO who gets replaced. I keep a standing one-page defense summary updated every quarter. Our vulnerabilities, our counter-arguments, our shareholder base breakdown. When the call comes, I'm handing directors answers, not questions.
Shareholder base breakdown, meaning you know who actually owns you?
Right, and most CFOs don't. Not really. You need to know your top 20 institutional holders and where they'll vote. Because the activist wins by convincing the passive giants, BlackRock, Vanguard, State Street, to side with them. Those three control enormous voting blocks. If you haven't cultivated those relationships in the calm years, you're negotiating with strangers during the war.
So the CFO who ignores boring investor calls for 2 years pays for it.
Pays for it with their job. Investor relations isn't a cost center you visit quarterly. It's your early warning radar and your defense budget rolled together. The activists treat it as a full-time discipline. You should too.
Give me the one thing a CFO should do tomorrow morning.
Build the activist's deck against your own company, the sum of the parts, the underperforming unit, the lazy balance sheet, and take it to your CEO this week. If it makes you flinch, that flinch is exactly what someone's about to charge admission for. Better you find it first.
Write your own hit piece before they do. That'll ruin a few weekends. Done. Want to know where you actually stand? Take the CFO self-assessment at mba-training.com.